A lot of people focus on working till 65. Is waiting that extra 2 or 3 years that big of a difference when you could be living the life that you want? You have to pay the IRS an extra 10% on those distributions, including taxes. Well, David, what are some planning opportunities I could possibly take advantage of? What you're going to notice is that during their retirement years, they're actually at a lower tax bracket. This is their RMD age. So you can see that once that happens, they're kind of stuck. People haven't saved enough for retirement. What if we were to do some tax planning earlier and avoid this jump where we're stuck, right? That 401k now can be looked at as an asset where you can start doing tax planning. You can start getting ahead of forced RMD withdrawals sooner rather than later. Welcome to the Financial Leadership Podcast. I'm David Afraimi, CEO and co-founder of BAM Advisory Group. Each week on the show, we're going to talk about how to build lasting wealth, take control of your financial destiny, and lead with confidence in every aspect of your life. We'll also dive deep into what it truly means to be a financial leader for yourself, your family, and your community. Let's go. Turning 59 and a half, the retirement milestone that no one talks about. And you've celebrated a lot of milestones, turning 16, turning 18, 21, and of course the traditional retirement age at 65. But the one milestone that most people don't talk about, it flies under the radar and it's a game changer, turning 59 and a half. This is when the retirement rules shift. This is where all of a sudden you have access to key retirement accounts without penalties. If you're working, in most cases, you can actually start moving money out of your 401k into your own IRA, and you get to choose your investments versus only working with the cookie cutter investments your 401k plan offers. And you can keep your current 401k account open and continue to get your match and continue to contribute. But let's go ahead and start off with penalty-free withdrawals. This happens in your retirement accounts when you hit 59 and a half. If you access your retirement accounts before 59 and a half, you have to pay the IRS an extra 10% on those distributions, including taxes. But once you turn 59 and a half, you avoid those early withdrawal penalties altogether. That's a game changer, especially if you want to retire early. Now, the second piece of this is if you're working and you're contributing to a 401k, getting a match, once you hit 59 and a half, in most cases, not 100%, it's all dependent upon your plan rules, but in most cases, you have the ability to roll out all or a portion of your 401k into your own retirement plan. Now, David, why would I want to do that? Well, because number one, in a company-sponsored retirement plan of 401k, you usually have a limited set of investment options, mutual funds, maybe anywhere from 8 to 10 to 12. When you start rolling that money out on your own, again, once you hit 59 and a half, now you can customize your retirement plan. You can own things like individual stocks or cryptocurrency or annuity. Basically, whatever it is that you want that's important to you, you now get to dictate what you own versus your employer getting to dictate what you own. One thing to consider is you still keep your 401k open. You still contribute up to your max. You'll still get your match if you're getting a match, if that's applicable. So you're not closing the account. You're just moving that money over into something that's more customized and it's more catered to you and where you're at in your retirement journey, right? Once you get 60, you're probably at a stage of your life where you want to take on less risk. A lot of times when we review 401k accounts for prospective clients, they've never changed their risk level. Now you can start customizing it to where you can take on more risk, start planning for income because you're really getting closer to your retirement years. It doesn't mean that you're withdrawing from your account. You're just moving the account so you have more flexibility and more options. So remember, 59 and a half, really kind of that milestone that no one talks about, but it's really an important time in your retirement years where you can start taking back control of how your money's invested and the planning that you can start doing. You don't have to wait until you're retired. You can start doing this at 59 and a half, especially while you're still working. What we're going to talk about now is, again, once you turn 59 and a half, now you have access to all or some of your 401k, which for a lot of people, that could be most of their retirement accounts, especially if they're still working. Well, David, what are some planning opportunities I could possibly take advantage of once I turn 59 and a half, now that I know that I have access to some of that money? Well, number one, you can go from your 401k into a Roth and start doing tax planning. Because remember, if you're born after 1960, your new RMD age is age 75. If you're born before 1960 and not taking RMDs, your RMD age is 73. So the idea here is you turn 59 and a half. You now understand that either all or some of your 401k is accessible. You can now start doing Roth conversions to see if that makes sense. And what we're going to show you here is a hypothetical client example of someone doing Roth conversions now versus waiting until they have to take their RMDs and showing you the difference in tax savings. Okay. So what we have here is, again, Tim and Tammy sample. They got about $1.5 million in retirement accounts. And really what we want to show you is that a scenario where they start doing Roth conversions now waiting until when they take RMDs, and now their RMDs are due. Now they're stuck in a higher tax bracket. Okay. So now what we're going to do is run what's called our tax scenario and show someone what their lifetime taxes are. So what you're going to see here, if Tim and Tammy wait till their RMD age, over their lifetime, their taxes are going to be $734,000. What you're going to notice is that during their retirement years, they're actually at a lower tax bracket. But then what you're going to notice is, see how the blue bars go up really high? This is their RMD age. So you can see that once that happens, they're kind of stuck, right? They continue to pay more taxes under two circumstances. One, their money continues to grow. And B, every single year you get older post RMD age, the IRS actually forces you to take more money out. So the question becomes, what if we were to do some tax planning earlier and avoid this jump where we're stuck, right? All we're going to do is say, hey, in the years where you don't have to take your RMD, what if we were to do some tax planning? How does that help? Here's what you're going to kind of see is that in these early years, what Tim and Tammy were willing to do is pay taxes earlier, because what they wanted to do is they wanted to mitigate their RMD requirements when they turned 75. And in fact, in this scenario, we got rid of most, if not all, of their IRAs so that when they turn RMD age, they don't even have to worry about being stuck in a higher tax bracket. So the end result in this potential hypothetical scenario is that this has the potential to reduce their lifetime taxes about $111,000. But then what it did is it created a potential tax alpha in their portfolio of additional assets of $3 million. Because the way this works is that the longer you have money growing in a tax-free Roth IRA, where that money's compounding year in, year out and growing tax-free, that's also money that's not RMD applicable. And in this situation, not only could you potentially reduce your lifetime taxes in this scenario about $112,000, but you'll also have the potential to increase your overall portfolio assets of about $3 million. In another way that I can show this is a side-by-side comparison of showing you how your tax-free assets are growing versus not doing any tax planning. So if you were to say, well, I don't really want to do any Roth conversions or tax planning, David, because I don't want to pay higher taxes today. I'd rather just kick this can down the road, right? And what you can see in this base facts scenario, essentially what this is, them not doing Roth conversions and just waiting till their RMD age. And then at that point, that's when the IRS kind of controls your tax scenario, because now you're forced to take withdrawals, whether you need to or want to, and then you're going to be stuck in a certain tax bracket. And we're comparing this versus let's be aggressive in doing Roth conversions now to show you what the net result is. So what you can kind of see here, I'll show you the numbers here in a second, but I'll kind of show you this based upon these bars. So these light blue bars are all of their tax deferred assets, your pre-tax money, IRAs, 401ks, it could be 403s, 457s, things of that nature. And for Tim and Tammy, these are their taxable assets. This is their after-tax account. They don't have any tax-free assets. Now, if we do some tax planning, you can see we are aggressively getting rid of the light blue, and sooner than later, we're getting to this, we can call this orange, or if you want to call it orange-brown color. These are their assets. So you can see at end of life, they're leaving more tax-free assets than tax-deferred assets. And we'll talk about the advantage of that has as far as your legacy plan and your beneficiaries. But if we scroll down, what you're going to compare side by side, in the base case, the tax deferred assets that are left behind are about $2.3 million. And where that could be a hindrance to your beneficiaries is that the current rules on leaving IRA money to non-spousal beneficiaries changed in 2020 under the Secure Act 2.0. That essentially says that, hey, if in this scenario, if they left $2.3 million to their kids, your kids under current rules today, and who knows, this may change, they have 10 years to take this money. Well, what if they're in their prime earning years, or what if they're dealing with their own taxable assets, pensions, IRAs, 401ks, RMDs, whatever? Your beneficiaries could lose 20, 30, or 40% of this money over that 10-year period where they're forced to take it out. Or under our tax planning scenario, what if we left them $5.7 million of tax-free assets? Now, they still have to take the money over 10 years, But in this scenario, they could actually let the money grow for 10 years. And real simple, to get your money to double over a 10-year period of time, you need a 7.2% rate of return. So let's just say this $5.7 million doubles. That's over $11 million that you could leave tax-free to your heirs. That is game-changing tax planning. So again, what we're talking about in this example is that if you're 59 and a half, you're still working, you now have access to your 401k. That 401k now can be looked at as an asset where you can start doing tax planning. And based upon a situation in your example, you can start getting ahead of forced RMD withdrawal sooner rather than later. Now what we want to talk about are the new max out catch-up contributions within your 401k over age 50. Really what we're just going to do simply is pull out the new tax facts, what we call this our 2025 tax summary. This is all from the IRS. This is all simple stuff. So what you're going to see here, and I'm going to highlight this, is your individual 401k contributions. They've let you add a little bit more money. So we want to highlight this period right here. And don't ask me why they've made it 60, 61, 62, and 63. It's probably because savings in America, it's not really good. People haven't saved enough for retirement. But now if you're between the ages of 60, 61, 62, and 63, you can now add an additional $3,750 per year tax deferred. You probably also do this in your Roth 401k. If you believe taxes are going to be higher down the road because of the $35 trillion of debt that we're in as a country, and you want to start putting more money away, but you want to do it where that money is growing, compounding, tax-free, you can check with your employer because certain employee plans allow you to do this, employer plans allow you to do this, some don't. You can now contribute an extra $3,750 between the ages of 60 and 63. And some of that could be put into a Roth 401k, which you can let grow and compound. And then the more tax-free money you have just puts you at a better position when you start taking distributions from your retirement accounts. If you got a good amount of your money in tax-free buckets, then it's going to help you really kind of control your tax brackets where you're not forced to jump up as much versus if all of your money was pre-tax. Now what we're going to talk about is a couple prospective clients. This is a hypothetical client example of folks that want to retire before 65. I think a lot of people focus on working till 65 because that's when you can claim Medicare and your health insurance costs go down. But really in the grand scheme of things, is waiting that extra 2 or 3 years that big of a difference when you could be living the life that you want? So in this example, we're going to show you how we solved, again, for a hypothetical client that wants to retire earlier, meaning before 65, and we're just building in a budget, right? We're designing an income plan to cover their medical expenses, right? So again, what we have here is Tim and Tammy sample. They've got about $1.2 million in different investment accounts, about $1 million in IRAs, a couple $100,000 in a Roth, and $100,000 in checking. They want to retire early. So, they want to retire now because they want to travel more. They want to live life. They want to spend time with their grandkids. They don't want to wait 4 more years. Remember, life expectancy in the US for males is about 77 years old. So the difference between 65 and 77, which is 12 years, and 61 versus 77, those extra 4 years, that's an extra 30% of living the life that you want. I think most people, especially Americans, are programmed to retire to age 65, and they don't realize that because of the wealth that you have, you actually can retire sooner. Again, some of their financial priorities, we're going to cover a lot of this stuff, but really it's just making sure they have the appropriate insurance coverage, meaning if I'm going to retire now, I've got to have a budget for insurance premiums until I turn age 65. So some of their income is going to be Social Security. They also have some rental income. And then we have their expenses. In this situation, what they're trying to solve for is, hey, if we retire earlier at 61, how are we going to pay for these medical expenses? I think logic says that you're just going to pull money from your investment accounts. But when you do that, you have things like sequence of returns risk. What's the market going to do? What about creating a defined income plan so that we can avoid things like market volatility and have more predictability in our retirement plan? The cash flows report is going to show us, based upon the situation, they want to plan for medical expenses. Do they have an income gap? So it's really this 4-year period to them that's kind of their sensitive period, right? Because they're going to have to withdraw from their investment accounts for a 4-year period to satisfy that they want to retire early or to pay for medical insurance premiums. Ideally, what you want to try to avoid is just pulling that money from investments that are tied to the market, because if you have to sell stocks when the market is bad, that's not always a positive thing. And in some cases, depending upon how much money that is, that could really set you back in retirement. So essentially what we did is we built out what's called a defined income scenario to cover their medical expenses. And we'll show you this in a clear example. In our planning scenario here, where we're covering the medical expenses, they don't have an income gap because we've essentially moved some of their money from their investments, or what we call BAM Advisory Group, their growth bucket, to their income bucket. And I'm going to show you this visual here that really makes this super simple. So in this example here, what you're going to see is got about $20,000 at an income gap. Again, what most advisors will tell you is, oh, just pull that money. You got $1.2 million. That's not even that big of a withdrawal rate. It's like a 2% withdrawal rate. I could tell you from experience, 26 years, you really don't want to have to withdraw from your investments over a long period of time consistently. Yes, one-offs. Hey, I'm going to go on this trip, $30,000. Yeah, you withdraw that from your investment account, not a problem. But for built-in expenses that are longer than a year, ideally, you should have intention behind that money. And in this case, money that's set aside that's going to pay you the income that you need to cover the expense. So all we did to cover the gap in this potential client example is simple. We basically moved $250,000 from their growth bucket. And now this money is moved aside for the next 4 years. And it's designed to pay them out an income benefit that keeps up with the health insurance premiums, and it's also going to keep pace with inflation. And those defined income investments can be a wide variety of investments. You can use things like bonds, stock dividends, structured note, income funds. Some people use annuities. To us, I don't really care what it is. It's really what matches your needs, your goals, your timeline, and your risk tolerance. But this is a better way to fill in an expense pre-retirement like medical costs, because now, kind of going back to the rules of the income bucket, this money is reliable, it's dependable, it's not tied to the stock market. It's something that you're not really worried about risk. And then 4 years, when your health insurance premiums go down, if you no longer need that income, that $250,000 or whatever it is can be repositioned back into your growth bucket for long-term growth. Or you can just continue on with income because maybe you actually want to spend that money. So this was just a real easy example on how we would solve, and again, this is a potential client scenario, for a short-term or a long-term, we call it 1 to 4 year additional expense. So if you're thinking about retiring early, but the thing that's holding you back is you want to wait till you're 65, I'm telling you, if you have the money, I think getting the time back is worth waiting 3 or 4 more years, because we never know how long you're going to live. So now what we want to talk about is Social Security maximization. I get this question a lot. When's the best time to take Social Security? And I think really the best thing to do is, first and foremost, is go to ssa.gov and get your benefit projections, right? They're going to show you at 62, which is early retirement, full retirement age, which for most people now is 67, or it could be 66 in whatever months, depending upon when you were born. And then of course, delayed retirement is age 70. There is no benefit for waiting after age 70 because your Social Security benefit doesn't grow. From age 62 to age 70 under current law, your Social Security benefit grows by 8%. Recent reports just came out. The Social Security Trust Fund is now saying that the Social Security Trust Fund will be exhausted or bankrupt by 2033. So 1 year earlier than the last report that came out. Now, I know people freak out about this. Essentially what that means is if no changes are made to Social Security, if it gets to the point where the Social Security Trust Fund does go bankrupt, then they'll be able to pay like 79 cents on the dollar. So I think it's smart to do a what if scenario with your financial advisor, if you have one, to say, hey, what if my Social Security benefit gets reduced by 20%? How is that going to affect my retirement income and lifestyle? Am I going to have to live off less, or do I have enough assets to pool to create more defined income, or whatever that is? But what we just wanted to show you in a quick snippet, what the break-even point is based upon taking Social Security at full retirement age, in this example, 67, and delayed retirement, which is age 70. So what you're going to notice here is that the break-even point here is right about at age 82. So essentially, if I take Social Security at age 67, if I live past age 82, I've left money on the table. Now, there's a lot that goes into taking Social Security just beyond the bigger benefit. We recorded previous episodes that talk about all the different things that you want to deal with when it comes to taking Social Security, so you can go and watch it. But there's things like taxes, there's things like spending down your assets, there's things like leaving money to your spouse. There's all of these different factors. But in this example, so I think one of the things that we're talking about here is your health. If you're 67, you're thinking you're going to pull the trigger on Social Security. We're just talking about how long you're going to live. Of course, nobody knows, but if you're going to live past age 82, you've probably left some money on the table when it comes to maximizing Social Security. You've really got to model out multiple scenarios. We got to talk about taxes. We got to talk about, okay, if you're not going to take Social Security early, you're going to lean on your investments. What does that mean for your investments long-term? And all these different things that you've got to look at, talk about, and discuss, because it's just not as simple as looking at Social Security through a peephole. Because if that was the case, everyone would take it at age 70. But when we factor things like taxes, your other investments, longevity, is there an opportunity for your spouse to get a bigger benefit if you pass away? You've really got to work with someone that can model out all these different scenarios. But we just wanted to show you in this really quick scenario here that if you were deciding between age 67 and 70, what's the break-even point? It's about 14 to 15 years. I get this question all the time. Hey, David, how should my assets be positioned while I'm still deferring retirement? Like I'm in my 50s. And then what should it potentially look like once I hit age 60? I think it's simple, right? The longer you have until retirement, you maybe should be leaning more on growth. So what I wanted to show you in this example here, here's somebody that's age 50. This is a hypothetical client. They want to retire in about 10 to 15 years. They have an income goal of about $120,000. Of course, that'll be adjusted in inflation. They know when they retire, they're going to get $90,000 from pensions and Social Security. So what we have here is their goal is 120. They already have defined income of 90 when they retire against Social Security and pensions, but they have a gap of 30,000. They're not necessarily concerned about their income gap now because they're earning income, right? They're deferring retirement. And this individual has about $1.9 million all in investment. So to me, it's like, hey, if you have 10 to 15 years before retirement, and again, everyone's different. I'm not saying this is a one fits all type of strategy or approach. BAM Advisory Group, we really pride ourselves in the customization. No two clients are the same. But in this example, I would say, hey, at $1.9 million, you have 10 years. You can almost look at all different 10-year charts going back 30 or 40 years, 50 years in the history of the market. You can chop it up in different 10-year increments. Of course, nobody knows, but generally 10 years later, your assets should be worth more if they're invested in the market. We do have the lost decade in the 2000s where we had the 2000, 2001 correction and the 08, 09 correction. That's probably the one anomaly. But outside of that, every other 10-year period, the market has substantially grown from the starting point up to a 10-year period. So in this example, we're saying, hey, leave that $1.9 million in growth. Hey, David, if I want to solve for that income gap and now I'm age 60, I'm thinking about retirement. Maybe you're going to retire in the next year or the next 5 years. How should my 3 buckets look? And we'll give you this example here. So now it kind of looks different, right? If I'm meeting with somebody who has about $1.9 million, they want 120. We already know 90 is already earmarked from Social Security and pensions or whatever it is. Then what we want to talk about, we want to kind of be proactive. You have 2 different types of advisors that you can work with, proactive or reactive. I think you really want to work with a proactive advisor because the proactive advisors are always looking ahead and making sure that it's goal-based financial advising. It's not reactive where you're coming to them after something's already broken or they're trying to fix a problem. It's like fixing the water leak after it's leaked versus trying to check all the time to make sure that the water pipe never breaks. But in this scenario, all we're saying is let's move $500,000 of that $1.9 million into your income bucket. So now we're putting intention behind that money. You might ask, well, what did you invest that $500,000 in to close that income gap? Well, it could be a host of things. It could be bond laddering. It could be stock dividends. It could be structured notes. It could be income notes. It's all about the client, right? What's their risk tolerance? What's their time horizon? What are their liquidity needs? There isn't a one size fits all type of strategy. It could be a host of things. I mean, I think you want to diversify your income bucket as much as you diversify your investments in your growth bucket. So in this simple example, 10 years later, now this person is 60, they're really close to retirement. We don't want all of their money in the market because of market risk, sequence of returns risk. We can go on. And we're kind of like earmarking that future income. So now we put that $500,000 away, whether it's next year, 3 years, or 5 years. They have about $120,000 of predictable, reliable income, but they still have another $1.4 million that they can withdraw from whenever they have some needs and wants. So this is just a real simple example of the different type of buckets that you have when you're at age 50 and how your money could be allocated, and then when you get closer to retirement. So here in this hypothetical example, we have a couple clients that want to take on some additional traveling and they want to build, so it's an additional expense. and they want to build a scenario where they now have a travel budget on top of their other expenses, but they want to do it in a way where it's the income coming to them is defined, it's predictable, it's not tied to the market. So again, we're going to talk about our 3-bucket philosophy, how we solve for income needs as they arise, whether they're predictable or things that just pop up. We like to say that BAM Advisory Group, our planning is dynamic. Our planning kind of morphs and caters to you because all of our clients have a dynamic lifestyle, things change. So we're going to kind of talk about in this potential client example, how we would solve for an additional travel budget if you were to come in and walk into our office. Okay, so again, here we have Tim and Tammy sample. They've got about $1 million in different retirement accounts. They got about $250,000 in cash. What I see, and I think this is a mistake, what most people do is that when they have these additional expenses or whether it's travel or whatever it is, they just pull their money from their cash bucket, which is okay to do. But I really think your cash bucket is there for an emergency. It's really there for things that are the unexpected costs, right? I really think your retirement money is there for a reason. You should be spending the money that is the most expensive as far as what does the IRS control. If you don't start spending this money or converting this money or donating this money, you could leave a tax problem to your spouse or your beneficiary. So we're going to kind of walk through how we would potentially solve this for a potential client. So let's kind of go through their facts. They're retired, age 65. Their life expectancy is age 90. They have $70,000 in base level expenses. They've got Social Security and they've got a pension. But what they have additionally, besides their expenses of $70,000, they have a travel budget of $30,000. Because if you think of your go-go years, this is why, if it's possible, we always recommend a BAM Advisory Group for our clients to retire earlier. Because the one thing that money can't buy and the one thing that you don't have control of is time. And the difference between retiring at 61 or 62 and 65 could be a game changer as far as the experiences that you can have with your spouse and your loved ones. So in this example, these folks want to have a specified travel budget, but they want to do it in a way where they're not spending their cash and they're just not withdrawing accounts from the stock market because of things like market risk could be a problem. If we look at their cash flow report, we're going to show that they're going to have an income gap based upon those additional expenses, right? So that income gap is essentially for like a 10-year period of time. What a lot of advisors tell their clients to do is, hey, it's only $35,000. That's about 2.5 or 3% of your portfolio. Just withdraw that from the market. But I'm here to tell you, it's never a good idea to sell stocks when they're going down to satisfy any type of income need. Why would you want to do that? We should have intention behind our money and actually have predictable income that would satisfy this need. So we're going to show you real quickly a side-by-side comparison of a defined income strategy, how we can solve for this need for this potential client and basically just get away. So you can see in our scenario here, we don't have an income gap. That's because what we did is we moved money from their growth bucket, and I'm going to show you here in our 3-bucket example, to their income bucket. So now they have defined predictable income and they're not having to worry about stock market returns or anything like that. So if we look at their 3 buckets, you can see this is what it looks like before we solve for their travel budget need, right? They have about $250,000 in their protection bucket. And we highly recommend this is money that should just be in cash for emergencies, like those expected costs. Here they have their income needs. They have $70,000 for their base level expenses, but they have this income gap of about $35,000, which is now their new travel budget. And they have about $1 million in their portfolio. So all we did is we moved about $425,000 from their growth bucket to their income bucket to satisfy their income needs. Now you might say, well, what did they purchase to get that type of income that is predictable, dependable, not tied to the stock market? Well, it could be really a variety of different investments. It could be a stock dividend portfolio. It could be bond laddering. It could be structured notes. It could be income funds. You can use annuities. It's really what is most important to you from a risk tolerance standpoint, a liquidity standpoint, and a risk standpoint. So there's so many different investment strategies that are available. If you're working with the right type of investment advisor, that we believe the best one is independent. We can really customize this to you. We can really provide you with the best deliverable. Now, in this scenario, now that they have all the money that they need and want, that is predictable, that is reliable, not dependent upon the stock market, and then they still have about almost $600,000 in their investment accounts, their growth bucket, to access in case something else pops up, a want or a need. And this is how you can simply plan for something like a travel expense, or if you wanted to fund a college for your kids, or we've done one of these for medical expenses. It really doesn't matter. But if an expected expense over a period of time, I think having a defined plan with intention for income is the best way to do it. We can eliminate a lot of stress and worry that comes with markets that we can't control. If you're curious about how we help people protect what matters most in their retirement, and you just want to see how our process works for you, give us a call or visit our website at www.bamadvisorygroup.com. You can schedule a 15-minute, no cost, no obligation, no pressure phone call with one of our advisors to get all of your questions answered, to understand your options, and for us to be able to provide you with more information and clarity. And if you're enjoying the show, don't forget to like and subscribe. Thanks again for watching. We'll see you all real soon.